It's good to see, Jim. We're all trying to make sense of these, what seem like fantastic numbers, but then again, offset against what you think the Fed may or may not do and how you think that's going to impact markets over time.
I think this is really, really good market for this, really good numbers for the stock market, Andrew, here. It is just one number, and they tend to be volatile, so you got to take it with a grain of salt. But what this did, I mean, I think a real concern was building with the bond yield collapsing towards 1% on the 10-year here. Earlier this week, as we were down to 112, we're now almost up to 129 this morning. That is a huge turn. I think technically that's going to raise a lot for a lot of people that bond yields are done going down and maybe headed up again. And what this does more than anything is it causes a big shift in the leadership of this stock market. You can see this already where the NASDAQ's off a lot this morning, and small cap stocks, their futures are way up. The S&P's not doing much, but the undertow here is shifted towards cyclicals and smalls, and maybe even international markets to some degree, those more sensitive to the economy, and away from defensive and growth stocks, which have been leading for a while here. And I think that's the undertow. I think the other thing this does is sort of calm down these COVID fears a little bit and reminds people that there's still an incredible fundamental story here going on, not only being reported by company earnings, but now on Main Street as well, and calms some of those fears. Yeah, tightening's going to come at some point, but I'll tell you what, when we're growing earnings like we're growing them, and we have a sub 1.3% 10-year Treasury yield, Andrew, I think we got to get some tightening in the system before the stock market's going to run into real trouble.
Good morning, traders. This is your daily brief with Captain Jim James. I hope you all had a great weekend. Grab yourself a cup of coffee or a whiskey because this is going to be a long one. On Friday morning, I watched the numbers reported, and I also was watching the tape very closely. The reaction to the numbers did lead me to turn on or check CNBC at some point during the day to see if they'd wheel out Art Cashin, as the market reaction reminded me of the Senate election in November. You'll remember that in Friday's daily brief, I did mention that the NFP and unemployment numbers could be great and contradict a tapering dump. And this is very similar to what took place in November. When the Senate election took place, there were 2 seats that were left undecided, which left the election undecided in whether the Democrats or the Republicans would firmly hold the Senate. Now, they did roll out Art Cashin, and he explained that the market stayed up because the Senate would not go to those 2 Democratic seats, and that the market was forward-looking that the Senate would be Republican. Now, of course, 2 weeks later, we find out that no, those 2 seats did go to Democrats, and the vice president became the tie-breaking vote. Now, the markets should have dumped at that point, right? Because the Republicans were not in control of the Senate. Well, the market did not dump. It continued to move up. And they dragged Art Cashin out once again to talk about that. And that reminds me a lot of the taper dump that we didn't get. And I don't think we are getting a taper dump right now, even if we have a minor pullback or correction. So keep that on your plate as we move forward. You will hear the boogeyman come out of the closet saying, look at this, we actually are getting a taper dump. When meanwhile, you'll miss out on buying these great dips that are going to present themselves. Because the nod in other aspects of the market is that the market is going up. Unknown news may briefly impact the market, but known upcoming market news is only used to fit the narrative of where the big boys want the market to go. I know that's a long statement to make, but there's a lot of meaning in that. And on a similar note, oftentimes I'm asked why I'm bullish when placing bets with bad news on stocks or exiting stocks or shorting with great news on stocks. And it's for those same reasons. The news is usually only being used to position a long bet or exit a long position to go short. So what does all of that mean for the markets this upcoming week and month? Well, you don't have to take a look at the market that doesn't lie, and that's the bond market. And sometimes you have to somewhat look at the US dollar and gold as well. As we know those markets can be manipulated, but they do tend to tell some truth as to where the money is going, right? So feeding this, will also be more economic news starting with CPI on Wednesday and PPI and claims on Thursday. So you're going to have the boogeyman with taper talk coming down the pike, right? That will be the bear thesis in the coming weeks. And they will use any pullbacks in the market, even if it's small, with some uncertainty in CPI and PPI and claims on Thursday to try to get that market to pull back, to get prints on short positions. But on the market moving upside, the 10-year and gold and somewhat the dollar is showing that there will be some risk put into the market, and those are really the things you want to be looking at. And also this week, don't lose sight of the fact that we have a big earnings week on small and mid caps, somewhere like 900 to 1,000 of those. And then remember that those job numbers included a recovery in like travel and leisure and service sectors. So that does give some sort of a nod towards these earnings reports being quite good for some of these companies, to be quote unquote recovering at least. And then lastly, you want to also weigh in the quantitative easing express, that whether you want to admit it or not. And it is funny because it now includes more stimulus talk. I will try to post that on Twitter today, but somewhere yesterday I saw in the news that I think it was Talib, one of these senators is proposing permanent payments to people that make less than, I think, $75,000. Now, the proposal of that bill is irrelevant. What is relevant is that that bill is proposed, and as long as it's debated, stays alive, or stays in the news, that is considered part of that quantitative easing carrot. And we all remember last year when they used those carrots, the markets went up, and whenever whenever the thought of stimulus going away happened, the markets went down. So those will be used to make the market pump and for the market to dump. So now we have what? We have talk of more stimulus. We have the infrastructure bill carrot that will be toted around. And then we have the eviction moratorium, which now there are lawsuits being made against the CDC. But so you'll see those three things be used over the coming weeks to both pump and dump the markets. Now, overall, we have to put all these pieces together and find out which direction the market is going to take. And that does bring me back to that guy that they wheeled out on CNBC. Where did he say the money was going to be this week?
It's good to see, Jim. We're all trying to make sense of these, what seem like fantastic numbers, but then again, offset against what you think the Fed may or may not do and how you think that's going to impact markets over time.
I think this is really, really good market for this, really good numbers for the stock market, Andrew, here. It is just one number, and they tend to be volatile, so you got to take it with a grain of salt. But what this did, I think a real concern was building with the bond yield collapsing towards 1% on the 10-year here earlier this week, as we were down to 112. We're now almost up to 129 this morning. That is a huge turn. I think technically that's going to raise a lot for a lot of people that bond yields are done going down and maybe headed up again. And what this does more than anything is it causes a big shift in the leadership of this stock market. You can see this already where the NASDAQ's off a lot this morning, and small cap stocks, their futures are way up. The S&P's not doing much, but the undertow here is shifted towards cyclicals and smalls, and maybe even international markets to some degree, those more sensitive to the economy, and away from defensive and growth stocks, which have been leading for a while here. And I think that's the undertow. I think the other thing this does is sort of calm down these COVID fears a little bit and reminds people that there's still an incredible fundamental story here going on, not only being reported by company earnings, but now on Main Street as well, and calms some of those fears. Yeah, tightening's going to come at some point, but I'll tell you what, when we're growing earnings like we're growing them, and we have a sub 1.3% 10-year Treasury yield, Andrew, I think we got to get some tightening in the system before the stock market's going to run into real trouble.
All right, so you got that, right? So that would be probably the Art Cashin kind of a guy coming out of the woodwork, or them wheeling him up to CNBC to tell you where to be putting your money. Now, another place you can look to see where the money is going is the 10-year Treasury note. And what you want to be looking at is this firm bottom that was put in place. And the 10-year going up infers that the market is going to take more risk on, that people will be culling their bonds, taking profit. Another hint would be the price of gold. You will see that the price of gold did fall off on the 8th, specifically on yesterday. There was a massive dump in gold, and the dollar, of course, came back. Now, when you see a dump in gold, that does not hold well for the market crashing. That shows a weakness, or of course, it's showing a weakness in gold, but it's going to show some strength later on in our markets. Now, the only negative side to this viewpoint that the markets are going up, of course, is the dollar. Now, right now, the dollar is trying to make a jump up and above to catch some support up here above 11,953. And we might get this inflationary play where the dollar moves up and the market continues to move up. Now, what moves up and what will move up in this market would be small caps and the S&P 500. Now, the NASDAQ might fall back a little bit or start to trail off over time. But if you remember last fall, that also happened as the S&P and IWM moved up. NASDAQ fell back a little bit, but it came roaring back later in the month. And my expectation for NASDAQ is possibly for that to happen, where you see a small bleed off or pullback on NASDAQ. And meanwhile, while all the bulls are jumping on board small caps and the S&P, the banks will be buying the bottoms of NASDAQ for another run much higher into the end of the month. So my viewpoint right now is that the market does not fall in any meaningful way that bears are expecting. Now, this week, we do again have that CPI number coming out at 8:30 on Wednesday, and we have claims coming out on Thursday at 8:30 a.m. That might lead into some volatility that will give some good opportunity to buy some bottoms in the market this week, specifically the NASDAQ. And looking at the ES today, we are looking for this new support. This was resistance just the other day, and you can see we've had two bounces on ES here, and we have a new so this has become support, and above has become resistance, this 4437.50. I do expect even if we start to test lows and come as low as 4366, I doubt that we break through here and fulfill that bear tapering issue of, hey, are we going to come back down to 4331 or 4320? I am doubting this move lower. So today I'm going to be looking to hopefully take some profits today or tomorrow if we can get down here to this 436.9. Hopefully I can get some of the prints that I have to print down here, though, for the next leg up into 4481.75. On the smaller time frame, you'll even see some resistance down here, as we talked about, around this 440.67, and possibly even seeing some resistance down here at 439.89. We also talked about 436 being the deepest that we go. So today, my call on the SPY is going to be a bounce off of 441.50. That's right down here. I'm looking for this bounce this morning and a move up to retest 443.31. The risk on the downside is going to be this 440.55, 439.93, and then heading back to this chart. The deepest we could possibly go, I see, in the next 2 days would be 436.7.75. Moving on to the NDX. Let me bring up the NDX on a larger time frame here, and you can see that we broke above this resistance right here. You can see this resistance line here. We broke above, and it is possible that we slide down over the course of this week here, down and retest these numbers of 15,023 and possibly even as deep as 14,865. I'm not bearish until we break down below these two numbers here, somewhere around 14,865, 14,800. In reality, I'm looking for some sort of bounce. This is where I'm looking for a dip bounce or a dip buy this week. So hopefully we can get this to come down, grab this for the next move up later in the month. So my expectation for today is that hopefully we trade down to 15,009 and we make our move back up to 15,122. Look for a big dip buying opportunity in the NASDAQ. On to IWM. this trend line right here, this white trend line, you want to keep your focus on as we move forward in the coming weeks and month. Remember that video that we watched earlier? That would infer that the IWM is looking even more bullish than it was in the past. Another note to that would be the 10-year and even the dollar, if we get some inflation, could still point towards at least small caps moving up. People have to go to Walmart whether they like it or not. People have to go out and purchase gas. There are things that people have to spend money on regardless if the dollar goes up. So you want to check this trend line. And right now, as of right now, as we come in to retest this trend line, I am buying this this trend line or anywhere below it down here, which is where I have these numbers at 211, 213, and 216. Today, I'm looking for no less or no more of a drop to 215.25. We make our next move up to retest 225 again today, and then make a continued move up to 230 or 235. And that's moving up into this vicinity up here. Here'd be 235 right here, and here is 230. Now, moving on to Tesla, and why I was speaking earlier about I buy bad news is exactly for what took place this week on Tesla. Now, I am bullish on Tesla because we keep retesting this resistance up here. Now, we did lose support Thursday, or we lost the will to move up Thursday and Friday. I attribute this to call options expiring this past week. Now, I do think that we could possibly still have some room to come down to this 682 number right here, and even possibly down to this 653. So my plan right now is to buy some slightly outside the money call spreads, and if we continue to move down, I'll go more aggressively on weekly call options for a spike up between now and August 23rd. I do not think that the rise of Tesla is over. As we've spoken about in the past, there's a lot of equity buying down here in banks, and in the short term, nothing is showing me any big sell-offs in Tesla. This is more of a rhythmic move. That Tesla tends to go up 10 to 12%. It tends to come back anywhere from 2 to 5% for its next move. That's all I've got for you today. I look forward to seeing you all on Twitter. Have a great day trading.